Are you ready to discover the key to achieving early retirement? Today we're going to unlock the secrets behind two powerful investment strategies: dividend stocks and growth stocks. Get ready to make your money work harder for you. Understanding dividend stocks. Dividend stocks have a long and illustrious history, playing a crucial role in the investment world. Let's dive deeper into the fascinating world of dividend stocks and uncover the key aspects that make them so appealing to investors. Pros of dividend stocks. Regular income stream. One of the most attractive features of dividend stocks is the consistent stream of income they provide. As an investor, you become entitled to a portion of the company's profits, distributed in the form of dividends. The steady flow of cash can be especially beneficial during times of market volatility, when stock prices may be fluctuating wildly. It provides a sense of financial security, knowing that you can rely on a regular income from your investments, regardless of market conditions. Dividend aristocrats. These are companies that have demonstrated the exceptional track record of increasing their dividends year after year, typically for at least 25 consecutive years. Stability and lower risk. In an ever-changing market landscape, stability is a highly sought-after quality for investors. Dividend stocks tend to be associated with more established and mature companies that have a history of weathering economic downturns and challenging market conditions. These companies often operate in industries with steady demand for their products or services, allowing them to generate stable cash flows. As a result, dividend stocks are perceived as relatively lower risk compared to more speculative growth stocks. Investors looking to balance their portfolios and reduce overall risk often include dividend stocks to provide a cushion against potential market volatility. Furthermore, they can offer an added layer of protection against inflation. As companies increase their dividends over time, the purchasing power of those dividends grow, helping investors maintain their standard of living even in the face of rising prices. Exploring growth stocks. Growth stocks are the darlings of the stock market, capturing the imagination of investors with their potential for explosive expansion and remarkable capital appreciation. These belong to companies that are projected to grow at an above-average rate compared to the overall market or their industry peers. These companies are often in their early stages of their development, with products or services that have disruptive potential. Investors are drawn to growth stocks for their ability to generate substantial wealth over a relatively short period. The next Amazon or Google. What if you could get in early on the next tech giant before it takes off? Growth stocks have the potential to make your dreams a reality. Pros of growth stocks. The primary allure of growth stocks lies in the potential for remarkable capital appreciation. As these companies experience rapid growth and increase their market share, their stock prices can skyrocket, leading to significant gains for early investors. The allure of investing in the next Amazon, Google, or Tesla is what makes many seek out growth stocks. One of the defining characteristics of growth stocks is their involvement in disruptive industries and technologies. These companies often introduce groundbreaking innovations that transform traditional markets, create new business models, and change consumer behavior. From electric vehicles and renewable energy to artificial intelligence and biotechnology, growth stocks offer investors a chance to be part of a revolutionary advancement that shapes the future. Growth stocks are known for their high earnings growth rates. Since these companies are in their growth phase, they typically reinvest a significant portion of their profits back into the business to expand operations, develop new products, or enter new markets. This reinvestment fuels their growth trajectory and attracts investors who believe in the company's long-term potential. However, it's essential to acknowledge the potential risks associated with growth stocks. Volatility and risk. While growth stocks offer the potential for substantial returns, they also come with higher levels of volatility and risk. The rapid expansion of these companies can lead to sharp price fluctuations, which may not be suitable for all investors. It's crucial to have a clear understanding of your risk tolerance and investment horizon before diving into growth stocks. Moreover, investing in growth stocks requires careful research and due diligence. Not all companies experiencing rapid growth will sustain their momentum, and some may experience setbacks or challenges along the way. Distinguishing between genuine growth opportunities and speculative bubbles is a skill that successful growth stock investors develop over time. Some major differences: economic and market conditions. Dividend stocks. During periods of economic uncertainty or market downturns, dividend stocks can offer a sense of stability to investors. The regular income from dividends can act as a buffer against market volatility, providing a reliable cash flow even when stock prices are experiencing fluctuations. Dividend-paying companies tend to be more mature and resilient, making them a favorite choice for conservative investors seeking to preserve their capital. Growth stocks. Growth stocks, on the other hand, are more sensitive to economic conditions and market sentiment. They may experience higher volatility during economic downturns, as investors become more risk-averse and may prioritize capital preservation over aggressive growth. However, during times of economic expansion and market optimism, growth stocks may outperform dividend stocks, delivering impressive returns to investors. Tax considerations. Dividend stocks. The taxation of dividends can vary depending on the country and local tax laws. In some regions, dividends may be subject to a lower tax rate than ordinary income, making them a tax-efficient option for generating income. However, it's essential to research and understand your local tax regulations regarding dividend income. Growth stocks. Since growth stocks typically don't pay dividends, investors may benefit from tax deferral on capital gains. Investors can choose when to realize their gains, potentially delaying tax liabilities until they sell their shares. This flexibility in managing taxes can be advantageous for long-term investors. The importance of understanding business life cycles. Now that we've explored the captivating worlds of dividend and growth stocks, it's time to unveil a key factor that plays a pivotal role in making wise investment decisions: understanding business life cycles. Just like how dividend and growth stocks have their unique characteristics, nearly all publicly traded companies fall into one of three business cycles. Understanding business life cycles is essential for investors, as it provides valuable insights into a company's current state and potential future prospects. Companies go through different stages as they evolve and grow, and each stage presents its own set of risks and opportunities. Let's explore why comprehending business life cycles is crucial for making informed investment decisions. Assessing risk and potential. By identifying where a company falls within its life cycle, investors can better assess the associated risks. Companies in the raising capital stage are generally considered riskier due to their heavy reliance on external funding. These companies may face challenges in servicing debt or may need to dilute existing shareholders through secondary offerings. On the other hand, self-funding companies that consistently generate profits tend to be less risky and more stable investments. Understanding a company's stage in the business life cycle also helps investors gauge its growth potential. Early-stage companies in the raising capital stage may have significant growth prospects, but are subject to higher uncertainty. In contrast, mature companies returning capital to investors may have already experienced rapid growth and are likely to focus on sustaining profitability. Making informed investment decisions. Investors can tailor their investment strategies based on risk tolerance and investment objectives when they understand the business life cycle. For those seeking aggressive growth opportunities, early-stage companies with high growth potential may be attractive, even though they come with higher risks. Conversely, investors prioritizing stability and income may find mature companies that return capital to shareholders more appealing. Identifying growth opportunities. Understanding business life cycles allows investors to identify companies with growth potential at an early stage. Recognizing businesses that are in the raising capital stage presents an opportunity to invest in potentially high-growth companies before their value is fully recognized by the market. However, such investments require thorough research and a higher tolerance for risk. Evaluating dividend and buyback policies. The stage of a company's life cycle also influences its capital allocation decisions. Companies in self-funding or mature stages may choose to return excess capital to shareholders through dividends or stock buybacks. Dividend-paying companies can be attractive to income-focused investors, as they provide a regular income stream. Additionally, stock buybacks can enhance shareholder value by reducing the number of outstanding shares, potentially leading to higher earnings per share. Recognizing industry and economic trends. Understanding business life cycles also helps investors identify broader industry and economic trends. Industries that are dominated by companies in the raising capital stage may be experiencing a period of rapid innovation and disruption. On the other hand, industries with a higher number of mature companies returning capital may be more stable and mature, potentially experiencing slower but steady growth. With a comprehensive understanding of dividend and growth stocks, as well as the significance of business life cycles, you're now equipped to navigate the dynamic world of investing and pave your way towards a prosperous journey to an early retirement.